There are a lot of ways to measure performance in commercial real estate, but there are a few numbers that are considered by far in this industry to be the most important. These are the metrics that are used by investors to come up with property valuations, market deals to raise capital, and calculate cash flow splits between partners within an equity waterfall. So in this video, I want to highlight 3 of the most important return metrics in commercial real estate, how and why each of these is used, and which of these you might want to focus on most when analyzing a deal. So the first metric I want to highlight in this video is the simplest of all of these, and this is the cash on cash return. This metric is calculated by taking the cash flow from operations distributed to investors each year, divided by the equity invested in the project up to that point. And what makes the cash on cash return unique is that this metric is measured on a year-by-year basis and only incorporates cash flow from operations within the numerator of this formula, which makes this a lot less speculative overall than many other return metrics. Most performance metrics that real estate investors use, including the other metrics we'll talk through later in this video, include an estimated sale value within the projected cash flows, which can make these heavily reliant on changes to capital market conditions. And the reality is that property values can be extremely volatile over time, and major swings in interest rates or investor demand for real estate, both of which we've seen over the last few years, can have significant impacts on what a property would sell for. And because of this, the cash on cash return is considered one of the most reliable metrics for investors who consider themselves somewhat risk averse and who prioritize a level of certainty when investing in commercial real estate. The cash on cash return is also, in a lot of cases, the most relevant metric for investors looking to supplement or entirely replace their income with cash flow from real estate, since this directly shows what the annual income stream is projected to look like on a year-by-year basis. For example, if an investor contributes $100,000 into a deal with a year one projected cash on cash return of 7%, that investor would expect to receive $7,000 in distributions in that first year of ownership. Now, obviously, these distributions aren't guaranteed, and these can be subject to change if rents were to decrease, operating expenses were to increase, or debt service were to increase due to a floating interest rate on a loan. But for investors looking to get more clarity on the income they could generate for every dollar they invest, the cash on cash return is really hard to beat. Now, the next metric I want to highlight gives investors more of a long-term view of the projected performance of a deal over a sustained period of time, and this is the equity multiple. The equity multiple is calculated by taking the sum of all cash flow distributions to investors and dividing this by the sum of all cash contributions from investors throughout the entire life of the investment. For example, if an investor contributed $100,000 into a deal, earned $7,000 per year over a 5-year period in distributions from ordinary operating cash flow, and the property was ultimately sold at the end of that 5-year period, producing an additional distribution to that investor of $150,000 at that time, this would represent a 1.85x equity multiple on that initial contribution. Now, unlike the cash on cash return, this metric factors in both cash flow from operations and cash flow from the sale of a property, and this also isn't calculated on a year-by-year basis. And because of how straightforward this figure is, this can be a really helpful metric to understand what an investor's projected profit would be on a deal in relation to their original equity investment, and whether that profit would ultimately be worthwhile based on the risk that investor would be taking. Now, one thing to note about the equity multiple is that this will inherently be higher the longer the property is projected to be held, since the numerator of this calculation factors in all cash flows generated throughout the entire life of the deal. But even though that's the case, this metric is still a really helpful benchmark for investors who want to understand their total projected distributions as a multiple of the cash they contribute. Now, the last metric I want to highlight here is, for a lot of investors, the most important return metric within an investment analysis, and this is the internal rate of return. The IRR measures the annualized time-weighted return on capital invested, taking into account both the timing and amounts of each cash flow, and is often considered the gold standard in commercial real estate for measuring investment returns. And just like the equity multiple, the IRR factors in both cash flow from operations and cash flow from sale proceeds, but instead of measuring a multiple of invested capital, the IRR uses a percentage figure instead to measure investment performance. This makes this metric a really helpful benchmark for investors looking to compare the projected performance of a real estate deal to other investment vehicles like publicly traded stocks or private equity investments. And because of this, most institutional investors will actually advertise their funds with specific IRR targets when raising equity capital. And these targets end up being so important to investors that these will actually dictate how these companies end up valuing properties in the market, with their maximum offer prices on deals typically being based directly on a purchase price that would allow them to either meet or exceed these targeted figures. For example, if an investor was considering buying a property for $10 million in an all-cash transaction, they expected to generate $600,000 per year in operating cash flow over a 5-year period, and then they expected to distribute $15 million in net sale proceeds at the end of 5 years. The projected IRR on the deal would be 13.6%. However, if that same investor raised equity from partners who were expecting a 15% IRR on their capital, this investor would now need to reduce their offer price down from $10 million to just $9.4 million just to make the deal pencil. Now, a downside of the IRR calculation is that because this metric is so heavily reliant on the timing of each cash flow, the IRR can sometimes be significantly higher with projected short-term hold periods, even if the deal is significantly less profitable than it would have been with a longer-term investment horizon. For example, if the investor we just talked about assumed to sell that same property for an even lower $14 million after just 3 years instead of 5, the IRR of the deal would jump to 19.8% with a 1.7x equity multiple. However, if the hold period was extended to 10 years instead of 5, even if the property was sold for an even higher $18 million at that time, the IRR on the deal would decrease to just 11.7%, even though the equity multiple would jump up to 2.6x. This is a big reason why the equity multiple is very heavily scrutinized by private equity firms and major capital allocators who invest as limited partners on deals, since a high IRR isn't necessarily always indicative of maximizing the total profit that could be generated on a real estate deal. Now, when it comes to the process of actually calculating the internal rate of return, the technical definition of this is the discount rate at which the net present value of a set of cash flows is equal to 0, but the built-in IRR and XIRR functions in Excel will calculate this automatically for you, so you don't need to do this manually by hand. If possible, the best practice in the industry is to use the XIRR function, which takes into account the exact day that each cash inflow and outflow occurs. But if you're just modeling out rough annual cash flow projections and you need to put something together quickly, Excel's simple IRR function will also do the trick. Ultimately, if you're analyzing a real estate deal, these are the 3 metrics that investors in this industry tend to focus on most. And if you want to learn more about these figures or how these might be integrated into an Excel modeling exam that might be given to you during the interview process at commercial real estate firms, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on real estate investment metrics like these, make sure to hit the like button and let me know. And let me know in the comments any other metrics that you focus on when underwriting deals. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week. And I'll see you in the next video.